Good morning. I'd like to welcome and thank everyone for joining us today for the WAM Capital, WAM Microcap, WAM Research, and WAM Active full year 2025 results webinar. My name is Tobias Yao, and I'm the portfolio manager across the 4 funds we manage. And with me today is Sean Wyke, Deputy Portfolio Manager. And Emiko Reid is also on the call. She will be moderating the question and answer session. Now, before we begin, a disclaimer is displayed for you, and as a reminder that what we discuss today is general in nature and should not be construed as financial advice. We also want to express our gratitude for the support of all of our shareholders. We are all investors in the LICs ourselves, and thank you for allowing us the opportunity to manage your capital. As Jeff always says, these are your companies, and we love to get the questions from you, so feel free to send through your questions for the Q&A session. Now, in terms of how the call will run today, I'll give it an update on the 2025 financial year and how our current views on the market. I will then hand it over to Sean, who will discuss the recent reporting season and how we've positioned the fund. And we'll both provide 2 stock picks before moving on to the Q&A session. Now, I think the last 12 months has been extremely volatile. And when we had the webinar 6 months ago, we were right in the thick of things. But the Trump's Liberation Day the tariff war induced significant dislocations in the equity markets. This was further exacerbated by the various geopolitical tensions. And so, the market was actually very volatile. As we've seen with previous market uncertainty and turmoils, the team rallied together. We focused on what we can control. And more importantly, we focused on sticking to our investment process. And for those of you that's been with us along the journey, the investment process hasn't changed since when Jeff first started the business close to 30 years ago. And that is to find and invest in undervalued growth companies with catalysts that could re-rate the share price over time. So luckily, the team has done a good job in acting decisively and in playing offense and using the market volatility as an opportunity to replenish our portfolio with high-quality companies with catalysts that could hold, that we're holding, that we think will get paid over the next 1, 2, and 3 years. Now, with that said, let's look at the 2025 full-year results. I'm pleased to report that all funds outperformed their benchmarks in 2025. WAM Capital and WAM Research outperformed the All Ordinaries Index by 9% and 9.2% respectively in 2025. WAM Capital and WAM Research also outperformed the Small Ordinaries Index by 9.9% and 10.1% respectively. WAM Microcap outperformed the Small Ords Index by 6.5%. And we were very pleased with the performance of WAM Active. The investment portfolio returned 26.4% for the financial year. Now, on the next slide, you can see the dividends announced for each of the funds and the current yield based on the share price as at yesterday. Given the companies which we invest in, our performance against the Small Ords Index is probably more representative of the stock selection process, given 50% of the All Ords Index is in banks and resources, which is outside of our investable universe, given it doesn't really fit with our investment process. And we've spoken about the underperformance of small cap companies over the last 4 years versus the broader market. So far this year, luckily, we've seen a reversal of this trend. So the Small Ords Index is up about 5% relative to the broader market. And as we've spoken about this in the past, one of the reasons is the reduction in interest rates in Australia. And so we are quite positive on the next 12 months for small cap investing. And now I'd like to pass it on to Sean Wyke to provide a summary of the reporting season and also how we've positioned the fund.
Great. Thanks, Tobias. Thank you all for joining us today. I'm obviously pleased to share our insights from the recent reporting season, outline some key market themes, and discuss our portfolio strategy to capitalise on the emerging opportunities in the Australian equity market, with a particular focus on our expectations for a period of small cap outperformance. So in terms of the reporting season we just had, the ASX Industrials delivered robust performance this reporting season. We saw around 11% net earnings beat, with resilience of margins the key feature. Small cap companies were the standout. They posted a solid 21% net earnings beat ratio, driving share price gains that outpaced their large cap peers. And as Tobias mentioned, this has been a reversal of the trend we have observed over the past 4 years. Why is this happening? Well, it's RBA rate cuts, and we think an improving economic outlook, which is supporting the early stages of a rotation into small caps. We've observed increased investor attendance at group presentations throughout reporting season, which is consistent with broker feedback suggesting renewed interest in, what are more economically sensitive smaller companies, which is a dynamic that's consistent with this stage of the economic cycle. However, the period was not without its challenges. One particular thing I'd call out was the share price volatility. This reached truly extreme levels at times, among the highest in recent memory, which would attribute to the rising influence of systematic investing and also passive strategies. This volatility, while challenging, does present very compelling trading opportunities, in particular for the WAM active strategy. A prime example of this was Megaport, which saw its share price drop around 20% at the open due to perceptions of an earnings downgrade, with aggressive reinvestment flagged for the FY2026 outlook. Our analysis, I suppose, supported a contrarian view to this. We believed a sustained reacceleration in revenue growth is really what aligns with, investor priorities, and given management's proven ability to deliver operating leverage in the past. This conviction was validated as the stock rallied over 20% during the earnings call, and really reflects growing confidence in CEO Michael Reed's strategic vision for the business. So I suppose digging in a bit deeper now into some of the market themes that I would highlight from the reporting period. It's very clear to us now that falling interest rates are driving positive momentum across the Australian economy, particularly in the consumer discretionary sectors, with CEOs much more optimistic in the conversations we had versus 12 to 18 months ago. Our portfolio maintains an overweight position in this space. We've got holdings such as AP Eagers, Harvey Norman, which reported 8.5% like-for-like growth in current trading, and Nick Scali, which was up about 7%. So, you're clearly seeing strong momentum flow through, from these initial rate cuts we've had so far, which really does reflect their sensitivity to this interest rate dynamic. The housing sector, broad-based, is also benefiting. Companies like mortgage aggregator AFG reported very robust lodgement activity. Land lease communities operators like Gem Life, they exceeded their prospectus forecasts. And peers such as Ingenia and Aspen Group delivered earnings upgrades driven by higher home settlements. In the construction materials space, Mars Group's optimistic outlook positions it as, a rare pure play beneficiary of the broad-based spend we're seeing in infrastructure and the resi market. And amid geopolitical uncertainties, tariff-related risks, we have maintained a bit of a strategic tilt towards domestically focused companies. The mining services sector recorded, what I think was its strongest reporting period in a decade. Companies like Monadelphous, SRG Global, NRW Holdings, and Tasmea Group, posting significant share price gains. Robust commodity prices, gold's obviously at record highs, iron ore's hanging very strongly, tight labour markets, and a strong capital expenditure outlook are seeing negotiating power much more evenly balanced, and this is paving the way, we believe, for continued margin expansion in the sector. Within the tech space, obviously, we think results were probably more mixed there, but we're encouraged by, I suppose, the exceptional performance of some of our key holdings, the likes of Life360 and Energy One, which posted really strong results and maintained attractive growth outlooks. Global optimism around artificial intelligence continues to drive elevated capital expenditure expectations. This morning we've just seen Oracle come out with some huge upgrades. The stock's up 27% after market. And from a domestic point of view, exposure to this trend does remain relatively limited in terms of the way to play it. We think Megaport's the highest quality, capital light play in this space, and it's very well positioned to capitalise on this AI-driven infrastructure demand. So I guess moving on to the outlook, looking ahead, equity markets have staged a strong recovery post, Liberation Day. But we remain constructive on the outlook, particularly for domestic small caps, which we believe are in the early stages of sustained outperformance. You've got improving economic indicators such as rising house prices, increasing consumer spending, and positive business surveys reinforcing our optimism for the Australian market. And, global risks, there clearly are some: tariffs, geopolitical instability, some bond market volatility. We're always mindful of what's happening on the global front, but our base case anticipates, continued global monetary easing, which, should help sustain cyclical momentum, we believe. And, on top of that, you've got the ongoing AI-driven capital expenditure boom, which is bolstering, global liquidity and investor confidence, we think, into year-end. So portfolio positioning, we think the portfolios are really well positioned to capture the upside from this improving domestic economic cycle. Cash levels are at approximately 12% at the moment, so we're retaining ample flexibility to seize on emerging opportunities. Really pleasing to see that deal activity has accelerated in recent weeks, with companies raising capital to fund growth initiatives, including, earnings accretive acquisitions. A notable example within our portfolio is Tobias's favourite stock, Tuas, which executed a transformative acquisition in the Singaporean telco market. The IPO market's also showing signs of revitalisation. We've had successful listings of GemLife, Virgin as well, from our conversations with ECM teams, there's a robust pipeline of future deals. So this environment supports our overweight exposure to small caps, which, we believe are well positioned to benefit from ongoing cyclical tailwinds. And, just looking at the next slide here, from a valuation standpoint, small caps do remain attractive relative to large cap peers and are supported by stronger earnings momentum in our view. We're maintaining a disciplined approach. Focus is high quality companies with strong fundamentals. And overall, we're confident in our ability to continue to deliver superior returns for our investors.
Stock picks?
Yeah, stock picks. So I'll go first. So, I guess my first pick is Tasmea. It's a founder-led provider of specialised maintenance services to the mining, resources and industrial sectors. It's far from being a mere acquisitive roll-up in our view. The company's achieving organic growth north of 20% at the moment. And its differentiation really lies in, a strategy of identifying, incentivising dynamic young entrepreneurs that are hungry, giving them, equity to drive, strong growth in their businesses and allow them to scale up. We think the stock's very catalyst rich. It's got, in our view, prospects of earnings upgrades, further accretive M&A post the recent, $30 million equity raise, which puts them in a great position. And, we think they're well placed at the moment for index inclusion within the ASX 300 in, March 2026, which, you'll probably hear a lot of people talk about the importance of index inclusions these days. And then my second pick is Zip. It's the leading buy now, pay later provider in Australia and the United States. Cynthia's doing a great job turning that business around, and we believe it was one of the standout results of the reporting season. The FY2026 guidance points to accelerating growth in the key US market. The stock remains under-owned by institutional investors here domestically, and we think there's significant upside in terms of earnings growth and, also valuation re-rate catalysts, including, potential NASDAQ listing next year. And obviously, peer Klarna is looking to list very shortly, and it's going to list it above the top end of the guided range and is about 8 times oversubscribed from what I've been reading this morning. So, those are my two. I'll pass it over to Tobias for, his two stock picks.
Thanks, Sean. And, Sean mentioned this earlier, the first stock pick. Now, I wanted to talk about this. I think we've spoken about this in the past a few times, is Tuas Limited, which is the Singaporean telco. The reason I wanted to mention this today is around 3 or 4 weeks ago, they entered into a transformational acquisition of M1 Telecommunication, which is the third largest player in Singapore. Tuas is the fourth largest player. And so that's going to consolidate the market over there back to a 3-player market. We believe it's a step change in the growth trajectory of this business, and it's on the back of flawless execution by the founder, David Teal, and the CEO, Richard Tan. And so we believe the acquisition itself, while this is going to yield a lot of synergy benefits, what the market perhaps is missing is the longer term market share opportunity for Tuas, and the platform that is now being created to not only execute on the opportunity within Singapore, but potentially outside of Singapore as well. So Tuas continues to be a core and large holding in our funds. The other stock which I wanted to touch on today is a company called Energy One. We are a substantial shareholder in Energy One, and we've only started been buying it about 12 months ago. The business provides software, trading and compliance software for energy, electricity trading in Australia and in Europe, and is a beneficiary of the amount of renewable energy product contracts or assets coming online. Effectively, if you're a renewable project, you need to sell electricity into the grid, and their software facilitates that as well. So they do that both in Australia and in Europe. They've talked to the market about and guided to the market to about 15% top line growth. Plus, they've had a really good start to 2026. And they're actually a very profitable software business. We quite like the management and the board as well. And while we've only been recent in the story, we've done quite a few industry meetings with customers and advisors, and are very positive on the stock. We think over time the catalyst for the stock would be continuing to beat earnings expectations and revenue expectations, and it's a high quality software business. And before I finish up, just wanted to also say that we've had a pleasing and positive start to the first 2 months of the financial year 2026, and particularly WAM Active, which on our estimates is up 18.1% over those 2 months. So we're really looking forward to obviously working hard to deliver continued performance for our shareholders. I would like to now hand it over to Emiko, who will go through any questions.
Thank you so much, Tobias and Sean. We've received quite a few questions from our shareholders. We'll start with Mads' question. What is your highest conviction investment across all the funds?
For me, in the next 12 months would be Tuas Limited, TUA, which is the Singaporean telecommunication company. That would be one. That'll be my one.
Yeah, I'm going to run with one that I chose too, Tasmea. I think this business looks incredibly well placed. As we spoke about the tailwinds that you're seeing across the various commodity markets, positions them really well. Management own, 50% of the stock. They're very heavily incentivized. We're all running in the same direction. Balance sheet's in excellent shape. Sorry, we think they'll do, some accretive M&A near term, and then as I said before, stocks under-owned institutionally, and we'll be in the, we think in the ASX 300 in March. So we really like the look of that one.
Great, thanks so much both. So the next question is from Mauro. He says, with markets at all-time highs and unsustainable multiples, how is the portfolio being positioned, and risk protection, downside risk?
Yeah, so from our perspective, I think there are two elements, the cash level. So we've had a good reporting season and took the opportunity to increase our cash level by taking profit in some of the winners. So our cash is pretty high. And I think the other point is, the market has had a very good run. However, the small cap companies have underperformed quite a bit over the last 4.5 years. And so from our perspective, the valuation for many of these businesses, we're seeing things trading on 10, 11 times price to earnings ratios that has very good growth prospects. So we think the valuation in the small cap space, it's a lot more reasonable, and we're seeing a lot of opportunities in that space.
Great. So with the next one, we've had a question from Michael, Lucio, Errol, and a few others ask about franking. When will we have 100% franking in WAM Capital and WAM Research?
Thanks for the question. I'll try my best to provide some context. So I'm not on a board, but it's the franking and the dividend policy. It's a board decision. for those of you on the call, also WAM Capital and WAM Research they're currently paying partially franked dividends, about 60%. In the annual report, I think there was comments around that for 2026, if we are able to sort of maintain the same dividend as last year, will continue to be partially franked. And so the franking credit balance is quite important in determining, I guess, and having sufficient certainty on the outlook is quite important to determining the franking percentage. The funds, we've had a really good performance and good progress on rebuilding the franking credits. But to lift it to 100%, I think the board needs to have more confidence on the outlook. I think the last thing they would want to do is to increase it to 100% and then having to decrease it because we haven't had enough franking balance. And for some of our new investors, just as a reminder, to pay fully franked dividends, we need to effectively sell shares in companies we made money in and effectively pay the tax, and therefore be able to pass that franking credits back to our shareholders. It's a little bit different to the profit reserve, which is for both unrealized and realized gains. And so currently WAM Capital and WAM Research they are partially franked. And the LICs, we've consistently paid a very high level of dividends, even during the COVID periods. And they benefited the shareholders then, but also it sort of ate into the franking balance.
Great. Thanks so much, Tobias. This next one is from Alison. She says, why has the dividend not increased since 2018? Will WAM Capital increase its dividend given the profits reserve of 27.2 cents at the end of August?
Thanks for the question. Again, it's a question for the board. But to provide some context, we think the 4 LICs right now are paying pretty good yield, like in terms of fully grossed up dividend yields. It's about 11, 9, and 10% across the four LICs, and we didn't want to further erode the capital return. Obviously, the more we pay out the dividends, the capital return declines. We're very happy with how the investment portfolio performance over the last 12 months, but to effectively maintain the current dividend, we need to deliver pre-fees about 15% return every year. So that's going to be the key for us to be able to maintain the current levels of dividend. We're working very hard to achieve the best performance we can as shareholders of the LICs in the LICs ourselves. But from the board's perspective, I guess maintaining the dividend levels is a prudent approach in the current market. And I think it's probably highly unlikely the WAM Capital dividend will increase at the stage.
Great, thanks so much. We've had a number of stock pick questions come through. Could you please give us your buy, hold, sell calls? We'll start with the first one, XRF Scientific, which is XRF in ticker.
Yeah, I'd say XRF's a hold at this stage. The key thing we're looking for there is, basically a return to improved top-line growth. Clearly, the cyclical dynamics are very favourable. One of our largest positions is ALS Limited, which is obviously benefiting from a significant uplift in, capital raising activity across the commodities complex. So, we do like the space. There are strong tailwinds, but at this stage, we just want to get more conviction and confidence that, we can see that top line generate stronger growth, and that's what ultimately will drive the valuation re-rating in that one.
Great. And what about Fleet Partners Group?
Fleet Partners Group is not one we are in at the moment, so I would say it's probably a hold at this stage. The one we do like in that space actually is Cog Financial. Tony Dwyer, from PSI Insurance has actually gone across there and made a pretty substantial personal investment in the business. And, one of their key verticals is obviously within that fleet management type space. Yeah, so at this point, we think, that one has a much stronger runway in terms of, its ability to undertake, M&A to grow the business, but also expand again organically across the panels It trades on a 13 times P. We think they can grow the business organically, 15 to 20% a year over the next few years, and then layer in some acquisitions. So, yeah, COG is the one that we're looking to play in that space.
Great. Next one is Qualitas Real Estate Income Funds.
We don't have a holding in QRI, but we do have a holding in Qualitas, QAL, the fund manager. So the reason we have an investment in QAL is due to they're the largest and I think the most conservative manager out there in private credit. Obviously, there's a lot of money flowing to private credit. A lot of the larger institutional or pension funds around the world that's looking to invest in Australia, they need to invest in effectively, the private credit fund manager that has a lot of scale. They've, been able to deliver 20% growth. And we think, with the seismic shift in private credit and the opportunities they're seeing coming down the pipeline, and the mandates they have in the background, it's quite an attractive growing fund manager that's in a space that's very attractive. And the founder owns a significant amount of, equity in the business as well, and then has been running it very, very conservatively.
And yeah, the feedback we receive across the industry is, very positive in terms of, Qualitas's risk management, framework, which is obviously critical in, running a real estate credit fund. So yeah, we think they're well placed, and QRI does look like an attractive vehicle to us.
What about Judo Bank?
Yeah, Judo's a buy for us. The stock's trading at a discount to book value. There's been a few, concerns more recently around, competition in the market, and is that creating, elevated runoff in their book and pressure on front book margins. But we think it's being overstated. They've shown very strong, gross lending momentum throughout, June and July. Front book margins are remaining strong. They're only 4%, market share at the moment. So there's still ample runway for growth for these guys. They've issued guidance for over 50% profit growth in FY2026. So we're really only just starting to see the operating leverage come, through this business. We think, if they can achieve their at scale metrics in that FY2027, FY2028 type pipeline, we think this stock doubles from here. So yeah, we like that one.
And let's see your thoughts on MA Financial.
Yeah, MAF's a hold for us at the moment, purely just on valuation grounds. It's now trading on sort of 23 times earnings. Look, we think there probably is risk of further earnings upgrades there, so it can probably continue going. It's a pro-cyclical business, in the sense that, it's obviously going to benefit from, improved capital markets activity. They've done a great job in terms of the MA Money product. We've got exposure, I suppose, to that, boom in, mortgage demand that we expect to see through AFG. And then, they've built a strong private credit business. So, yeah, if it wasn't for, the valuation, I'd be more positive. But yeah, we like them, and they're a good management team.
Great. So 40 Medical, is it a buy, hold, or sell?
It's gone up a lot. I'd probably say it's a hold, leaning towards a sell here, just purely because I feel like there's a lot of, retail speculation built into this one. And then, it's traversing through to commercialization is, generally the more difficult part with, these types of businesses. Atria Health, stock code AYA, is one that we actually really like. It's, in a similar space. It's effectively got, a software, AI-based software product that's being used effectively within CT scans to identify, plaque, being the most recent approval they've just received about, 3 or 4 weeks ago. And then also an approval upcoming in 1Q calendar year 26 around, effectively flow of blood, through the heart. They've just raised $75 million. They're extremely well capitalized now. We think they've got a strong pipeline of hospitals that they'll be able to, sign up over coming months. And we think that's going to drive a further re-rating that share price. Only a $250 million market cap, whereas 40X, I think, hit almost $1 billion yesterday. And, we think this one's got a stronger TAM and stronger product. So, yeah, AYA is what one we like in that space.
And last one for buy, hold, sell, Southern Cross Golds.
Southern Cross holds probably a buy for us. Yeah, I mean the deposit, that they've recently, came out with, obviously has the potential to be, massive, I suppose. So, it feels like you've still got good catalysts and good news flow there in the near term. Obviously the gold price environment's, very supportive. So yeah, I think that one's still a buy here.
Great. So this next question is from Michael. He says, why did you sell Maya? You had high expectations for the company.
So we reduced our holding in Maya. We are still shareholders in Maya, and then have quite a bit of Maya. As with the fund, we need to balance short-term and sort of medium-term catalysts. We obviously really like the management and the board in Maya, and we think they're going to deliver on some of the targets they've set out. I think from our perspective, it is from a portfolio standpoint, is to weigh up some of the shorter-term opportunities in the market and effectively trying to maximize the performance for our shareholders, or optimize performance for our shareholders. So, while we've reduced the position, we are still shareholders in Maya and still backing management.
Great. This next question is from Ashok. He says, will the small and mid caps outperform the ASX 100 during this lower interest rate cycle?
Yeah, I mean, if historical precedent takes place, then yeah, we're very strong believers that will be the case. And as we touched on earlier, we've seen that over the past probably 2 months, and we think with the prospect of further rate cuts, then small caps are really well positioned. The interesting thing that came out this reporting season was some very, very savage moves among the highly rated, highly regarded large cap companies. CSL, James Hardie, Woolworths. I mean, Woolworths is still on 35 times PE with 1% earnings growth. I'd much rather buy a small cap retailer like a Myer or something that's on 10, 11 times PE with the prospect of double digit type earnings growth. So yeah, we think we are in the early stages of a rotation towards small caps, and we do believe they will outperform the ASX 100.
Great. So this one is from Krish. What is the target for the companies? Capital growth, distributions, or both?
This is for the companies we invest in?
Yes, I believe so.
Yes. Look, for us, the key is catalysts. So just to provide a bit of background on that, in terms of catalysts, we're trying to figure out what are the things that could move the share price over the medium to the longer term, and sort of identifying these catalysts. And typically, it could be a potential earnings accretive acquisition or an earnings upgrade, and it's part of the process that we undertake to look for ideas and do the on the ground work. So the catalyst needs to effectively change the trajectory of the share price that we think, and so for us, that's the key of how we've always invested, and that's sort of how we invest.
Great. This one's from Joseph. Did WAM Capital subscribe to the To Us offer a few weeks ago?
Yes.
We took every share we could get.
Great. So this one's from Hung, and it's for Tobias and on To Us. What are your thoughts about Simba M1 merger being blocked by the Singapore ACCC? Do you expect the company to enter nearby markets in the medium term? And are there any regulatory issues you foresee in the medium term?
It's a really, really great question. Look, I think this is sort of our view. Obviously, the regulatory environment and the setup is a bit different in Singapore in terms of it's from our perspective, I don't think it's a surprise to the regulators or the IMDA over there of the merger. It's the third and fourth player getting together, so it's the one probably the easiest to get through versus if it's number 2 and number 4 or number 3 and number 2, it's going to be probably even be harder. So we think the regulatory risk, while there's always regulatory risk, it's not very high. It's not something we're really focused on, and I think over time David and Richard has proven to be very opportunistic and then to have a very focused team that goes after opportunities. One of the things, for example, that I think perhaps the market overlooked over the last 12 months is the amount of value Simba has added to their plans while holding the price points the same. And so, they are clearly working very hard in the background to be able to drive that customer value proposition, which drives market share gains. And so for us, it's couldn't be in better hands having, David and Richard running the show in Singapore. And I think if there are opportunities over time, I'm sure they'll be looking at it, and they're way smarter than we are.
Great. So Joseph and Deep have asked about capital raising. Would any of the WAM LICs you manage consider a share purchase plan?
I think that's, again, for it's on the capital raisings.
Great, thanks so much. Sorry, you cut out a little bit. But
Sorry, I was saying it will be a decision for the board.
Great, thanks so much, Tobias. So this one is from George. Is Healthco oversold, and do you have a position in any of the HMC Capital investment vehicles?
Yeah, so HMC was a stock that we did, that HMC Capital Headco was a stock we actually did really well on. In particular, sort of coming out of obviously the 2022 sort of weakness. I think we made over 100% on the stock, actually. As we see it today, like the HMC Headco itself, obviously has a few challenges, and they're directly sort of attributed to various issues that are happening in the underlying satellites. We're not holding any positions across, in HMC or across the underlying satellites at the moment. The Healthco rate, HCW, which you specifically asked about, it's just been deleted from the ASX 300 index. So I suspect there's going to be some selling pressure on that one, in the short term. Look, it's at a 30, I think it's over 30%, almost a 40% discount to NTA now. The last result only had sort of minor reductions in the underlying NTA. So I think you just need to get some clarity on Healthscope and, the broader dynamics there around, what kind of funding model that's going to go down before you can gain sort of a higher level of confidence. But yeah, optically cheap, but still, quite a bit to work through, I think.
Great. This question's from Sydney, has asked about resource stocks held in WAM Active. What is unique about Greatland Resources and Larvotto Resources? Yeah,
so I guess the key thing I'd say is the turnover in WAM Active, which is the fund that I manage, is extremely high. Greatland Gold was really a trade, I suppose around, it got absolutely smashed off the back of, what was a very disappointing update for FY2026, particularly in the context of the company IPOing or doing an IPO in Australia only a couple of months before. We're just playing a bounce trade. We no longer hold the stock. We think it's got to do some time, and management, have to really rebuild some credibility with the market. Larvotto, I guess again, too, not a large position within the fund. Really that's being played. That trade was placed around, I suppose, expectations of potential news flow for gold intercepts. Then obviously they're restarting the Hillgrove antimony mine. There'll be 7% of global supply when that ramps up in the first quarter of next year, and on a price to NPV basis, it's about an 8-month payback. So it's one of the cheapest mining stocks on the ASX. So yeah, we're still holding that one and still positive on the outlook.
Great, thanks so much, Sean. This one is from Phil. What steps will WAM Capital take to rebuild its profits reserves? Noting the profits reserve for WAM Capital is 27.2 cents at the end of August.
Thanks, Phil. So in terms of the steps, it's just for us to continue to invest in companies that go up, or to generate positive portfolio performance for all the LICs, and that's the key driver of increasing the profit reserves. I think I mentioned this earlier. we need to hold the dividend, or the levels of dividend. We need to probably deliver around pre-fees 15% returns, say for WAM Capital, and so that's sort of some of the rough numbers around what we need to do to deliver, the performance to drive the profit reserves.
Great. This one is again from Ashok. He says, how has WAM Microcap been performing this financial year, and what is driving it?
WAM Microcap's had a positive start to this financial year. Sean's talked about this a bit earlier in terms of over the last 4 years, due to the outperformance of, I guess, some of the larger companies, there is a lack of interest in the microcap space, where we're due to liquidity and the fact that they're not in any indices, doesn't benefit from the capital flow that comes from passive money or the super funds, etc. And so, with the recent rebound, early days in small cap companies, we believe if this continues, we're going to see more opportunities and more microcap companies outperform. The way the microcap companies have outperformed have historically concentrated on a few large positions that's done really well over a long period of time. And one of the advantages that we have across the LICs, I think it's quite unique to us, is the fact that it's the same investment team that manage the WAM Microcap Fund as well as the WAM Capital Fund, and often a lot of our best ideas within WAM Capital often comes from the WAM Microcap Fund itself. So we are pretty positive on the microcap space, given the, I guess, early days we're seeing the turn in the performance of some of the microcap companies.
Yeah, and the only other point I'd add to, in terms of the relative performance to the XSO over the last month or so, the small resources index was up 15% in August. That's a massive headwind, in order for us to overcome as pure industrial stock pickers. Like we obviously own, no gold and no commodity stocks, within, the microcap fund. So yeah, that's just the other point to note is the construction of the index. It's very gold heavy, and we don't have exposure to that area.
That's a good point.
Great. This next question is from Eric. Are there any significant detractors in the WAM portfolio, and what is the plan for those?
Yep, plenty of detractors. So reporting season, and I think also the other thing is in a positive market, a lot of it, I guess it's opportunity cost or investing in businesses that share prices that doesn't go up and doesn't go up with the market. But in terms of mistakes during the reporting season, we had a position in IPH, patent attorneys company. They effectively downgraded at the results. The share price fell, and then we sold out. Another company that downgraded, but we continue to like, is a company called Event Hospitality. So they run the cinemas, and they have a fast-growing hotel business, have a lot of assets. So that for Event Hospitality, we were able to take profit into the results. So our position size was reduced. The numbers.
Yeah, the share price had gone up about 40% over May to sort of the end of July. So yeah, we had taken we'd almost halved the position on the way in. And then, yeah, as Tobias mentioned, I mean, we're still positive on it. There's very strong asset backing there. So we've actually been buying back a few shares recently.
I think that's a testament to the active side of sort of our funds, that we can make these decisions.
Great. Thanks so much, both. This one is from Mark. What is your view on Generation Development Group following the Evidentia acquisition?
Yeah, we really like GDG. We've been there for 6 years. I think the last 2 years, the share price has done extremely well. The management team there, Grant Hackett, Rob Coombs, Terence, they've done an amazing job effectively growing the business and obviously making smart acquisitions. So Evidentia, we think a lot of these asset consultants, they effectively are the gatekeepers for capital in Australia. Organically, they've seen very strong flows from both the bond products and also the evidentia flows. And yeah, it's a growth company, and we think they're very well placed for the next 5 years.
Yeah, we think there's some good catalysts coming there near term in terms of the momentum they've got on flow side of things. Like the pushback on evidentia has been, I suppose that some of the flows have sort of pushed to the right, but management are adamant that ultimately they're maintaining what they've guided to into this year from a profitability standpoint. Because in classic sort of Grant Hackett, Terence fashion, the CEO and CFO, you always leave a bit up your sleeve and a few hedges. And yeah, we think they've got, plenty of levers they can pull to continue to grow that business very strongly. And one of the interesting points we picked up with them when we caught up with them over the reporting season was, the opportunity in investment bonds, directly with super funds. That's a new space. Clearly, Div 296 is, potentially a driver of that. So there could be some very significant flows coming there. So watch this space, I guess.
Okay, thanks so much. The next one is from George. Is QOR or QOR the next Live 360?
Great question. Look, we're very bullish on both, to be honest. We were early in 360. We've owned that stock from $4. It's been probably one of the best performers within the WAM Capital Fund over the past 5 years. Core area is now held across both. Going to Tobias's point earlier, where within WAM Microcap, we can have an early look at things get really across names. We're buying that stock at 30 cents, 25, 30 cents, and now we've got it in WAM Capital and buying it. We think it's passed through the free cash flow inflection point this year. It's growing its ARR very strongly. There's still a long runway for growth for the business to go. There's structural tailwinds in terms of the funding environment improving in the US. And, we do think they're well positioned to I guess, undertake bolt-on M&A. The September quarter is typically the big quarter in terms of, cash generation. So we think there's a good catalyst coming there, near term as well. So, that is one we like. And, going to the point of index inclusions, has recently gone into the ASX 300 as of the announcement on Friday.
Great, thanks so much. The next one is from Soham. How do you factor Australia's declining productivity into your investment outlook?
It's a great question. I think if you feel free to add, but I think a lot of the companies we invest in, we focus on pricing power. So companies where the product is very strong, the customer proposition is very strong. There's product market fit, and so when these businesses with pricing power, as they grow, we feel like any changes in perhaps overall productivity could be somewhat mitigated by the pricing power of these businesses to ensure the margins are stable. A lot of the small caps companies, I think those that's really embracing AI, and particularly the tech companies that's been very on the front foot, should actually see an increase in productivity for the business. That's the feedback we've had from many businesses, like say Temple & Webster, as an example. So that should actually lead to a change in productivity for us. So it's really because the small cap space is so diversified. It's really different industries and companies that have different productivity challenges.
Yeah, I think it's more a function of larger businesses where there's there tends to be quite a lot more bureaucracy and and whatnot in terms of how to manage cost bases. It's probably less of a factor, particularly across the more nimble, high growth businesses where everyone's running in the same direction.
Great, thanks so much. So this next question is from Claire from IIR, the research house. She has asked, where is Oscar? Great question.
Well, thank you for the question. So recently Oscar's been on leave, but he has been working remotely. I think I've spoken to him every single day, or Sean and I have, for the last month.
More than my wife.
Yeah, and which is a running joke internally. But he'll be physically back in the office with the team at the beginning of October. And obviously we sort of chat all the time. In the small mid-cap team, obviously Oscar's joined. We've been working with Oscar since 2016. I think Sean joined in 2019, Sam in 2018. And we have Cooper and Chris, who's been with us, particularly Cooper, since 2017. And so we have a pretty experienced team and a pretty good platform to continue running the portfolio here.
And Oscar, he's never had more than a week off, I don't think, in 10 years. So I'm actually looking forward to seeing him come back refreshed, reinvigorated, and we think he'll be on fire from day one.
Great, thanks so much.
We've already started to book in his meetings effectively.
Yeah, he's got a heavy travel schedule coming.
Work related.
Thanks so much. This next question is from David. What expectations for IPOs do you have in the coming year? Quantity, size, and sectors to watch out for?
Yeah, I mean, I'd say as a general standpoint, ECM pipelines are starting to refill for IPOs. I think at this point, they're generally going to be, I'd say, more towards the 300 to 500 mil type market cap range. We're seeing pretty diverse range of companies, anything from, the tech space, general industrials. There's a few things in healthcare, poking around as well. And then, I think the larger ones that are probably on the horizon are, things like Estia Healthcare that, which was a very good investment for us and taken private a few years ago. Given how well the aged care space has performed, there's obviously potential for that one to come back. And I'd say just as a general rule, we read a lot about, the assets that are sitting within private equity, and the fact that, a lot of these assets are, I guess, reaching the end of their fund lives, and they're going to have to try and find an exit somehow. So, yeah, it'll be fascinating to see sort of the next couple of years, what comes out of, some of these private markets, and whether the public market will actually have appetite for them or not, because there's a lot of pass the parcel happening in private markets at the moment.
Great, thanks so much. I think we'll have to do another round of buy, hold, sell. The first one is EVT. I do know you touched on it earlier, but maybe just a quick note on that one.
Buy for us.
Great. Objective Corporation.
It's a hold for us. We do like the business. They have pretty good growth. I think it's just more in the fund. We have some of the other tech businesses with higher growth that we've have invested in more heavily.
Tony's done an amazing job, founded their business. I don't know if he's ever sold a share. He's built a $2 billion company. For me on that one, it's getting more conviction on that AR outlook, particularly from an organic growth perspective, which has tapered off a little bit the last few years. And, we're obviously holders of Technology One too, who they do bump up against in certain aspects. And, that business has done a phenomenal job, and we remain supporters there too.
Great. Coast Entertainment Holdings.
Probably a hold. They have a very good asset, and it's a function of when they could, I guess, extract the intrinsic value of the asset.
It's probably just the timeline to unlock the value of the land. Like, obviously, there's been some press more recently around a large-scale hotel being built there, because at the moment you're just very much beholden to, the ebbs and flows of Dreamworld traffic. So, it's probably a hold for now, with the view that getting more certainty around the catalyst to unlock the value of the land.
And your thoughts on Beta Entertainment?
Yeah, so, Beta's a buy for us. Obviously, there's a lot of to and froing happening at the moment in terms of, the PointsBet acquisition. That could play out in various ways. They could ultimately be successful in, gaining control of PointsBet. there could be a scenario where Mixi, engages with them, and then, they essentially license the tech out, into Japan, the sports betting software platform. Or there's a scenario where Bluebet itself rolls into a larger entity, with PointsBet and Mixi. We're also not precluding other potential scenarios out there. Obviously, there's been some press around Ladbrokes and what are they going to do. There's been some press out there around, Dazen Sports. Now that's changed, KO's changed ownership towards Dazen. What do they want to enter the sports bet market? So, yeah, in short, the balance sheet's in great shape. We think they've got, plenty of optionality. And, we think irrespective of anything happening, right now, the core business is on about 4 times EBITDA. And they're about to get, if they weren't to proceed with PointsBet and they just got their cash back, that EV becomes even cheaper. So, in the various scenarios we look at, which are multiple on that one, we think it looks very well positioned to make money from here.
Next is Bisalloy Steel.
Bisalloy Steel isn't one I've actually looked at in a while.
But thanks for the tip. We'll have a look at it after the webinar.
We can come back directly after we've had a look at it.
Great. Breville Group.
Yeah, Breville, we like medium to the long term. Obviously, they've been one of the companies that was impacted by tariffs and had to make, and they were actually very proactive, having made decisions to effectively change the manufacturing base. They sell the coffee machines to Australia, the US, Europe, and now in Asia. We really like the management. They've done an incredible job growing the business, and it's really a market share story. In the short term, there's going to be a little bit of uncertainty around the landed margins and exactly how all the tariff impacts will play out. But from our perspective, from 2027 onwards, they are effectively selling more coffee machines and products, gaining share in all the geographic areas they're in. So definitely one to hold for the long term.
A2 Milk.
A2 Milk is a buy. We had a good position, decent position into the results. The management team has done an excellent job executing at the most recent results. They also effectively tick the box that a lot of investors were worried about, which is the supply and manufacturing of the product. David Bertolozzi, the CEO, did a back-to-back deal to sell the underperforming asset and actually buy another asset at the same time. And I think it's underappreciated his ability to get that across the line and effectively solve the issue that people have had. In China, the CEO Li Xiao has done an amazing job growing share and effectively winning share from the incumbents, other large infant formula brands, as well as the local brands, and increasing share geographically. Our view on A2 is that over time, they'll go from a one brand business to effectively multi-products under the one brand, multi-region. So it's not just China. They've gone into the Saudi Arabia, they've gone into Vietnam, obviously in the US, et cetera as well. So we think it has a lot of IP, the A2 IP, and so we're strong believers in the business and the ability to continue to win market share.
Great. Next one is SmartPay.
So SmartPay is currently under takeover offer, and so fingers crossed.
Yeah, we're holding on the basis that we think the deal closes. Yep.
Yeah, great. So, and your views on EML payments?
Yep. So that's one which we have a substantial holding in. The reason we are there, and this business has had quite a journey, bit of a roller coaster ride. The reason we're there in that size is because of the new executive chairman, Anthony Hines. He's taken over the reign effectively 6 to 8 months ago. Amazing entrepreneur who's proven himself before when he founded a business called eNet and sold it for $1 billion, which is also in the payment space. He's now come into EML. He's bought, I think, $3.5 million of shares on the market. The board has set the targets of, I think, it's about close to $20 million worth of shares for him. If you can get the share price to $1.40, $1.50 within 18 months' time. But underneath the hood, he's making a lot of positive changes to the business and reinvigorating growth, and really driving that efficiency really hard. So they actually upgraded in August, but so they're clearly green shoots. I think they've set out targets of $95 million for EBITDA in 2028. So they'll come very quickly in a blink of an eye, and we're really backing management, and Anthony and Peter there to execute.
Great, thanks so much. This next question is from Mehdi. What happened with Austin Engineering, and what was the logic behind the investment originally?
So Austin was originally inherited when we took over the Euros portfolio. So that's when we originally inherited that position. Post our due diligence, our conversations with management, we knew the CEO, David Singleton, from his Austell days and had a good relationship there. Understood the vision and what he was trying to build, and did really well, obviously, for us for a period of time. In hindsight, we probably should have sold more stock than we did earlier. And really, the change in management was, I suppose, a catalyst for us to sort of reassess our holding in the business. And then, we obviously saw some, I suppose, negative developments around, some of their key growth pillars in terms of the margin structure and whatnot with Batam. So, yeah, we've exited the position in WAM Capital, and we're holding a small weight in WAM Microcap.
Great, thanks so much, Sean. Phil has asked, would the board consider slightly cutting the dividend to retain more earnings and profits reserve? And just in addition, Andrew, one of the shareholders, joined late and has asked, will WAM Capital return to 100% franking? If you can please touch on that again too. Thank you.
Yep. So it's a question for the board. But in terms of the context, on the dividend side, our goal is to continue to drive positive portfolio performance. That's going to add to the profit reserve and obviously the ability to pay out dividends. And so that's going to be our obviously the thing we're working really hard on. We're all investors in the LICs ourselves. And so that's the first thing, second and third thing we think about every single day. On the franking side, I touched on this earlier. I think until the board has comfort around the certainty on the franking balance going forward and the ability to maintain the 100% franked dividend, it's most likely going to continue to be partially franked at around 60%. But there's always going to be mismatches in timing. So with the franking balance, it's realized capital gains, and versus the proper reserve is both realized and unrealized as well. So obviously driving positive performance is number one, and hopefully that eventually leads to the fully franking of the dividend. And the point I touched on earlier was also during the COVID period, we continue to pay a very high dividend, frank dividend yield, which benefited the shareholders at the time. However, it did deplete the franking balance.
Great, thanks so much. This next one is again from Ashok. What is your view on Cettire going forwards?
Cettire is not a stock we have in the fund right now. They are going through their challenges in terms of the changes to the tariff landscape. And so they're working through that. It's one we've had a small position in the past, but it's like all small cap companies, we look at it, we assess it when the results comes out, we go through it, and then if the opportunity is right, we can get back into it.
Great. The next one is from Glenn. Do you have an opinion on the Brickworks Soul Patts merger?
Yeah, we're very positive on the merger. We think it unlocks, obviously a good level of synergy and strategic benefit, for both sides, effectively unwinding, the previous structure. So we participated in the initial raise. We participated again in the second tranche raise that they did. And from here, there's a significant wave of passive buying that still needs to occur as a result of, I guess, changes in free float and index upweights. So, we remain very positive on that one. Clearly Tuas has been one of their, bigger holdings at which we've had, in good size for a long time now. We rate Todd and management very highly. We think they're very good stewards of capital. So, yep, we're definitely positive on that one and own that one in WAM Capital and active.
Great, thanks so much. This next one is from George. Do you invest in companies listed on the New Zealand Stock Exchange?
Yes, we do. We've got a number of holdings, that are on the New Zealand Stock Exchange. Somerset Group, which is a retirement village operator. E-Road, a small technology company, is also listed there. SmartPay, obviously. A2. We've invested recently in a company, Black Pearl Group. It looks like a very exciting, technology play out in New Zealand that's looking to move their primary listing here, the ASX. And that probably goes to the point. We struggle with the liquidity profile of the New Zealand Stock Exchange in terms of the stocks that we like to invest in. And it just doesn't have the same level of, passive tailwind, if you like, that the ASX does. So, if we're investing in New Zealand companies, one of my biggest learnings probably the past 12 months is you really want the listing, I hate to say it, to be an ASX primary listing because it just seems to, the investor universe is very different in the way people approach the companies. But I'd say New Zealand stocks generally, like they've probably lagged expectations. The recovery has been pushed out, further than what some are calling.
So this next question is from Ashok. Do you hold Australian broadband in your portfolio?
Aussie Broadband is actually one I bought in the active portfolio recently, post-result, which was obviously a very good update, a beat to FY2025 expectations and, guidance for FY2026, also ahead of the market. We think going forward, that's the challenger broadband space more generally. We've got shares in Superloop as well. Like this isn't a winner takes like all type industry. It's really about these challenger brands taking share from, the slow dinosaurs like the Telstra and whatnot, with better performing products, better service, etc. And we've obviously got a significant churn event coming up in a few months' time. So we think the challenger broadband players look well positioned here.
Great, thanks so much. This next question is from Philip. Do you like PEXA Group, given its pricing power makes it almost a monopoly?
Yeah, we used to hold PEXA, and I actually heard good things about it recently in terms of the new management. So definitely one to do the work on. And it is making headway in the UK as well. And I think in Australia, the environment's improved as well. So the business model is very attractive to us, and we'll be doing work on it.
Great, thanks so much. This next one is again from Claire from IIR and John, who have both asked, what was the catalyst thesis for IPH Limited?
Yep, it was twofold. So IPH have effectively patent attorneys. They have operations in Australia, Asia, and also in Canada. These were through acquisitions. Over the last few years, they've had effectively either one or more than one part of the three weren't working or was not kicking goals and had market share losses. And so heading into the results, we were more positive on the organic and the market share positioning for the three positions, and we thought that could positively surprise the market, effectively having all three regions producing positive growth, which would be the first time in quite a long time. And when we look at the margin profiles of the 3 different regions, it's also quite different. So Asia is quite high, and then you have Australia and you have Canada. And so our view was the self-help opportunities within the business to obviously get the margins up for the other 2 regions, and that would again be another catalyst because it will lead to earnings upgrades in the outer years. So unfortunately, we didn't see enough, or the market didn't see enough in August result for them to believe in the thesis, and so the catalyst didn't play out.
Great,
and
thanks.
there's obviously a CFO change there, Brendan York too, who we'd had a good experience on in the past with the Nero Group. We always pay very close attention to changes in management and backing good management teams. So yeah, there's a bit of a view, I suppose, that he would be able to get in there and make some changes to the cost base that probably just didn't eventuate to the degree that we thought it would.
Great, thanks so much, Tobias. Energy One was your stock pick, but Ian asks, given the share price of Energy One and how it has gone up, is there still substantial upside given the current price?
Yeah, I mean, over the long term, 100%. I think the top line growth really attracts us, and the ability for them to continue to participate in what's happening in the renewable space. The market in Europe is growing at 30% plus, and that's the market, as a lot of the electricity markets are opening up. And, we need effectively software to be able to trade across regions, across countries. Those changes really happened post, the Russian-Ukraine conflict. And so I think there are secular structural growth that's happening in the background that's really helping a business like Energy One, and that's really underpinning their top line growth in Australia. Obviously we've seen with a lot of the charts, and Genus Plus is another company which is benefiting from this, is the amount of solar projects, wind projects coming online. Each single project needs to be connected to the grid. In the case of Energy One, the software that needs to be used by the different projects is effectively what they produce. And they're 50% of the electricity traded in Australia. So they really benefit from the market growth here as well. So Australia historically has been growing at about 13%, and Europe has been growing at a higher rate. So we think it's going to go through a period of higher top line growth. They've talked through to operating leverage, so we should see the earnings come through as well. And in the August results, they talked about potentially acquiring, but only acquiring businesses if it's earnings accretive from day one, and that's quite important. And I think the management and the board are very conservative. So they have a very good track record there. And, we think if they open up another region, as an example, that could increase the total addressable market, and the business could be quite large in a few years' time. And
500 mil market cap, we think that really is the sweet spot for these, high growth, software tech businesses. Like, we wouldn't classify this business as well owned or well discovered at all from an institutional investment point of view. So there's still plenty of potential buyers, we think.
Great, thanks so much. This one is from Andy. What is the team's thoughts on G8 education following the bad press and price reduction?
Yeah, I mean, clearly it was, I suppose, press was obviously very disheartening and disappointing to see. And to be honest, we felt most, badly for, not only those affected, but also the CEO, Pedge, who's done a, amazing job with that business operationally so far, and all his staff. So, yeah, it was obviously, really sad to see for them. Look, I think operationally the impacts are probably overblown. And there is a significant amount of this now reflected in the share price. We took action, immediately and de-risked the size of the position, so we could sort of await further clarity as it sort of played out. So, it's no longer a significant holding, within the WAM Capital Fund. It hasn't been for, obviously a few months. From here, I actually think, assuming that, the actions or I suppose the government's view around this is to really, just install cameras and things like that. Like G8 have already got that done. G8 already screen all their employees, pre being employed, etc. So we don't think there's actually a lot the business needs to change operationally. And they've already been among the highest standard operators out there. So looking into FY26, cost of living pressures and whatnot have clearly had an impact through FY25. But I think, as we look forward, like the stock is very cheap. And if you believe that interest rate cuts are going to flow through, consumers are going to have more money in their wallets, some of the policies around childcare uptake, obviously positive for occupancy. Yeah, we actually think it's starting to look quite interesting again now. So it's a stock we're staying close to doing work on because, you could see quite an aggressive rebound into 26 if they can close that gap on occupancy and get occupancy improving again.
Great. Thanks so much, Sean. This next question is from both Ashok and Peter, who have asked, what are your thoughts on Drone Shield? Did you hold it in the portfolio before it was added to the ASX 200 index?
Drone Shield, we've done some active trading around it. There was a sell down at one point by, one of the US, I guess peers or competitors of the business that were, looking to potentially partner on some tech. It ultimately didn't go down that way. So we took some, the stock sort of rallied. So, and then we sort of sold it out. We didn't own it into the ASX 200 inclusion. As an overarching point, I'd say clearly there's very strong tailwinds at the moment around defence, globally. It's been flagged, by NATO nations, pushing from 1% to 5% of GDP by 2035. So, this is what I'd call a hot sector in the market at the moment, and share prices are reflecting quite a bit. But the ways that we're sort of playing it, I suppose that theme at the moment is through Codan. That's done a phenomenal job for us. Their communications business, about 40% of that's leveraged to military spend. And, they're only really starting to see the uptick in inquiry now. So we think they're well positioned. We've got some shares in EOS in the active fund. Clearly some very, significant developments there more recently with their high laser, I guess, technology sale. And then also, it sounds as though the pipeline there remains, extremely full into next year. So, the defence theme is very, very strong one in the market at the moment. But valuations, are reflecting that. And as we saw, about a month ago when, when Trump was trying to, I suppose, offer an olive branch between Russia and Ukraine, those stocks fell 10 to 15% in one day. Obviously rebounded since. So, it's sort of, you got to be careful because they are baking in a lot of upside, these defence names.
Great. Thanks so much, guys. We have a few more stock pick related questions that have come through. Could you please give us, again, your buy, hold, sell calls for Demerix Limited? That's the first company.
GXB, it's not one I'm close to, sorry.
Buy, hold, sell, and not applicable. It's probably...
Happy to come back.
We'll have to do some work on it. It's a biotech business. It's not typically our wheelhouse.
Yeah.
Next one is Tyro Payments.
Tyro Payments, I would say, we have it in a fund. I would say to buy. I think they've had with an asterisk, there's a change at the top with the CEO leaving. Moving on, and so they're looking currently for someone to come in and run the business, but they've had a very good start to 2026. It's a payment business. Obviously, we own SmartPay, which was obviously under takeover, and we think there are a lot of there are parties. I think payments is always a very interesting party for people to look at and for international businesses to get into Australia and having that payment network already there. So I think the intrinsic value is there for Tyro, and organically or from a business perspective, they're doing well.
Telix Pharmaceuticals.
Telix is probably a hold for us at the moment. Quite a few moving parts there at the moment in terms of, regulatory, I guess, factors. I'd also say too, clearly, Illuccix there, I guess, key product within the US market. It does look as though, competition, is starting to increase there. And yeah, I guess more broadly, the market penetration story has played out quite a bit now. So yeah, it's probably a hold for us. We have owned it in the past, haven't owned it for a little while now. But yeah, one that's on our is still on our radar.
Next is Electro-Optic Systems.
Yeah, I sort of touched on this one before, EOS. Yeah, I mean, clearly the defence thematic at the moment is incredibly strong, significant tailwinds, in terms of, increases in government funding coming into space. Stocks run hard, but I'm going to say it's a high-risk buy. It just feels like it's got the momentum at the moment. The pipeline's very strong. It feels as though it's, got a couple of, potential contract wins that could come through that, could be, further, game changers for the business, I suppose. And, this one's at, I think, 1.8, 1.9 bill market cap now. Drone Shield's for, a bit over 4 billion. And this one's got probably double the earnings from memory. So, yeah, stocks run hard, but I'd say it's probably still a higher risk buy here.
Sigma Healthcare?
Yeah, Sigma's a buy, we think. And it's one that, we've added to sort of post reporting. Yeah, I mean, the momentum within the Chemist Warehouse business is, clearly incredibly strong. Double-digit like-for-likes throughout, July and August. So, yeah, clearly the business has very good momentum. We do think it's a beneficiary of rate cuts going forward. And then obviously, with the growth in the GLP-1 drugs, a specific, I guess, theme they flagged was, as people come in, buy these GLP-1 drugs, they're buying other things in store too. So it actually is driving, quite a bit of incremental foot traffic. So that should be a good tailwind for them into FY2026. And it looks as though the offshore, expansion strategy with Ireland and whatnot is starting to gain some, and potentially broader Europe starting to gain some traction. The only thing we're cautious on there near term is obviously, there's been some management, changes flagged, which probably is unexpected. But yeah, the equity markets had to absorb a lot of stock from insiders, and the stock prices hung in there incredibly well. So, I'd rather buy a Sigma on 50 times growing, in the teens to low 20s, and Woolworths on 35 times, not growing.
Next is SKS Technologies Group.
That's probably a hold for us. And yeah, so in that space, we do have a few companies that sort of similar. There's quite a few companies, obviously, Tasmea, which Sean talked about, Genus Plus. We have SRG. We have ServiceStream.
NRW have acquired something that's sort of in the space recently.
So the overall space is we're pretty positive on the space.
Yeah, we think there's significant tailwinds still to come there. SKS is the least sort of diversified in the space. So yeah, we've just got preference elsewhere. But it's clearly got good tailwinds at the moment.
Great. Helios?
Yeah, so our exposure there is in ACL, Australian Clinical Labs. So the four-player market, we think ACL is doing a lot better on the margins. Obviously, there's a few challenges in the healthcare space, and so we are gravitating towards the ones that's being able to effectively have the more streamlined processes, more digitized processes that allows for high margins and provides more margin of safety in terms of earnings. And so, our preference there would be ACL.
And your thoughts on Nuix?
Nuix, probably a hold. It's one we've had a look at. It's had a few hiccups in terms of the and managing market expectations as well, in terms of the execution by management. And the thematic is very positive. I think it's probably perhaps more on the execution side, but it's one that we sort of go through actually in detail for every results, and just to see where there's an opportunity. And with a lot of the technology companies, we have to weigh up all the options that we have in the fund. It has to effectively be more attractive than some of the stuff we have in the fund to buy it. And so not something we hold currently, but I would say it's a hold.
Great. Thanks so much, both. So we have Deep, who has asked for your views on the global small cap sector. They have underperformed for a while.
That's probably a question we could come back to you from the WAM global team.
But if you the simplest thing, if you apply the same overlay that we do here domestically, like if you think the Fed's about to go through an easing cycle, then yeah, I mean, smaller companies should, in theory, more economically sensitive, have underperformed relative to large in the US as example too. So the same principles should apply.
Yeah, instead of the banks, obviously the Magnificent Seven, the large tech names, dominates effectively US equities.
Yeah.
Mandy has asked, why is WAM Capital delivering average performance?
I think I'm hoping the questions is around the share price. As an investment team, our job is to drive the performance of the fund itself. I think I ran this number earlier in terms of since 2022. Obviously, that was a challenging year. We've delivered, I think, on a one-year basis, an outperformance versus the market of about 12%. As at August, about 11% as at on a 2-year basis, and about 9% from a 3-year basis. So we've been able to consistently outperform the market over the last 3 years. I think perhaps the question was around the share price and the share price not keeping up with the market. And we completely understand. It's disappointing for those that bought share price at, I guess, at a much higher level. I think WAM Capital and particularly WAM Research were trading at a significant premium to the underlying NTA. So I think WAM Capital was around 30%. I think WAM Research got close to 60%. So effectively, if you're buying shares, then you're buying $1 of assets that's only worth $1 for $1.30 or $1.60. And that's been one of the reasons why the share price itself, the listed company, hasn't kept up with the market due to that premium reducing. However, we also pay out a very high grossed up dividend yield. So when we think about total shareholder returns, it's not only just the capital growth, but also the amount of stuff that we pay out. So if we, hypothetically speaking, didn't pay out any dividend, the share price, assuming the premium stays the same, should have reflected, I guess, the outperformance of the fund, the underlying funds itself.
Great. John has asked about Gentrack Group. What are your thoughts and why have you invested in the company?
Gentrack's gone from what we would have called like among the largest small cap darlings to, I'd say at the very least, divisive, borderline hated. There's a lot of noise in the market at the moment around, one small, which they obviously came out and disclosed, Red Energy, one small, contract that they didn't effectively knew just because, the terms weren't attractive. So going from here, I mean, may have seen we've filed as substantial shareholders recently. We're very big supporters of management. Gary's done an excellent job at the business so far. And we think the key sort of catalysts near term there are, I guess, contract awards. We think it'll only take a couple and this share price could move quite material just because they haven't had any sort of news flow in that respect for a while. And medium term, a business growing 15 to 20%, organically compound. And, we've got a lot of confidence around that. So, we think it's an opportunity to, I suppose, buy while there's blood on the streets and everyone hates it. And, you could see a pretty material re-rate if we're right, which hopefully we are.
But it's, just to add to Sean's point, I think a lot of the times, and for probably some of the new shareholders, when we do increase subs and companies, the weight itself, the weight of the company in the portfolio is not that high. I think sometimes you see us, EML, for example, we're 10% of the company, but obviously the market cap is a lot smaller. So the weighting of some of these businesses in the fund is not as large as what perhaps looks to be.
Great. So Ian asked for your thoughts on Alliance Aviation.
Yeah, I mean, Alliance, we've got a small holding in our microcap fund. The challenge there has been really just around, I guess the prospects of deleveraging the balance sheet. And it just has seemed to unfortunately keep sort of kicking out to the right. There's no question it's like the business is fundamentally, undervalued and cheap. But yeah, we just want to get more confidence in that deleveraging profile. We felt like at this result, it probably did get kicked out, about, another 12 months. So one that, we'll hold a small waiting in, keep our eye on and wait for the time to launch properly into.
Great, thanks so much. George asks if there would be any benefits in merging WAM Active and WAM Research into WAM Capital.
Yep. So WAM Capital, and I think there's obviously a question for the board, but just in terms of the difference, WAM Capital, has the research side of the portfolio and then also the trading side of the fund. And that's, when you put two and two together, you get WAM Capital. Otherwise, investors, they have the option to just purely invest in WAM Research, which is more the research side, or the active, which trades a lot more. So I think the ultimately, it's obviously a board decision, but, that does give shareholders an option depending on, what suits their specific investment sort of needs. And so providing that option, I think, is quite important.
Great, thanks so much, Tobias. This next question is from Ashok. He asks, what's your view on Mayfield Group?
Yeah, I mean, similar to like the comments I made before about G8, like the childcare industry has been tough, over the past, sort of 9 months, I suppose. Cost of living pressures have clearly weighed in terms of, occupancy trends. Did have a look at it really as a cross-check, throughout reporting season. Momentum was clearly building, in the business through the period. They've got the same challenge in the sense that, occupancy's, well down on last year. So I think going forward, if we come back to, the basic principles around interest rate cuts, more healthy consumer and, some supportive policies in the childcare industry, that should see occupancy rebound, which is the key driver of profitability for these businesses. So, I'd say it's probably a hold at the moment, but, they're looking more and more interesting, I think, these childcare names.
Great, thanks so much. This next question is from George, and he asks, what went wrong with the Digico floats?
Good question. I think the main thing that went wrong with the Digico float, aside from listing at a time when there was a bit of volatility in the market, was probably the structure of the deal and the size of the deal. It was made out as though it was kept incredibly tight, and you'd see this significant amount of, index and I suppose, and then, institutional buying post-listing, which, didn't really eventuate. From day one, the stock sort of never traded above the IPO price. And, there's a perception once that happens, it's inverted commas, a broken IPO. And it can sort of take some time to recover. So, I think at the moment, shareholders are sort of wanting to see, further progress on the SID assets and, whether obviously they can, you've got the HCF accreditation more recently. Now you want to see them start to fill some of that extra capacity within that data center. But at this stage, it's probably a hold, I think, and it's probably just got to do some time to operationally execute, show some more positive catalysts, and then people will be looking to revisit it.
Great. The next question is from Tony. What are your thoughts on IDP Education?
We own some IDP Education, a stock that we've been close to for a long time now. We sold our shares out sort of a few years ago when it felt like, I guess, the policy dynamics within each of their key markets were becoming more restrictive, and that's obviously what we have seen play out. There's been some more green shoots there more recently, I suppose. The Australian government have come out and said they'll allow a 9% increase in student immigration into next year. Obviously recognising that it's the largest services export for our country. So it's pretty important that they continue to support. I think there's some recognition of that now. UK, yeah, it does feel as though the policy settings are getting incrementally, more supportive. The stock's just left the ASX 100, so it's now back in the small cap index. So a lot of our peers in small caps will be dusting it back off and starting to do work again, and they'd have a more fond experience of IDP and would have rode it on the up cycle when the shares went from I think $4 or $5 to I think it hit $35 at one point. And come all the way back down now. Management are doing a good job on the cost base. So, yeah, we're holding it. It's not a large weight at the moment, but we think any incremental, positive news flow around policy dynamics in, Canada, and probably to a lesser extent, any further positives in the UK, you could see this share price re-rate pretty dramatically. Management are talking to a flat cost base into FY2027. So if you see a volume rebound with a flat cost base, we think there's actually pretty significant earnings upgrades that could come through. So a little bit early. So it's one that we've got a holding in and staying very close to.
Great, thanks so much. This next question is from Keith. He asks, what are your thoughts on Magellan's improved position and new management structure?
Yeah, it's quite interesting. It's still on a list of things we're doing work on. I think the thing that really piqued our interest is around Vinva. So that's the quant fund. I think that's doing really well. And so really understanding how the strategy of that, that part of the business over time. And so, yeah, it's one that's on the to-do list.
Great, thanks so much. Rick has asked, every month the WAM Capital investment update specifically mentions 1.61 cents of tax assets arising from the acquisition of investment companies. How can you realise these assets and realise these benefits of release?
Yep. Yep. So the capital loss is from historical acquisitions and can be offset against future acquisitions or future capital gains from future acquisitions. WAM Capital also recently realized around, I think, 2.2 cents per share of historical income tax losses and reduced it to the benefit of our shareholders.
Thanks, Tobias. This next question is from Cole. You have touched on Southern Cross Gold earlier, but how would you compare it to Tasmea?
Yeah, I mean, so fundamentally, Southern Cross Gold is a gold company versus Tasmea, which is essentially, a maintenance services provider to, the commodity and oil and gas industries. So, that's obviously the fundamental difference. Southern Cross Gold is going to get you, I guess, leverage purely to the gold price. Whereas Tasmea, we think, more diversified business, maintenance services operator. And as I sort of touched on before, balance sheet's in great shape. We think there's earnings that accretive acquisitions to come near term, and it trades at probably a 20% discount to its listed peers. With ASX 300 includes in March would be a key potential catalyst to close that valuation gap. So different industry, different risk profile, obviously. That's probably all I'd say there.
Great, thanks so much. John has asked, what are your 5 worst duds for the year?
5 worst duds. I'll say IP. So in terms of duds, we look at companies that we've sold out. So a lot of the times it's things that we still like, we're sort of adding to it and perhaps hasn't been realized. I'm just trying off the top of my head. IPH, Close the Loop. That's been one that's hasn't. GEM, G8, obviously.
Education was
Austin Engineering. That's unfortunately fail. I'm trying to think what else. And sometimes it's missing things that's gone up as well in an upward market. I'm trying to think what else. Those are 4 out of the 5.
Yeah.
Event hospitality, which obviously. But that's something, as we explained earlier, we quite like, and we're sort of buying it out.
Actively traded the weight, quite well around it.
Great, thanks so much. We've had more stock pick questions come through. So what are your thoughts on Pro Medicus?
Positive. Promedicus would be a buy for us. You know, they're the only business on one of the only handful of businesses in the world where they're delivering 30% top line growth and I think 75% EBIT margins, and they've done that for 10 years in a row. The product is well ahead of their competitors. And so they are currently, I think, around 11 to 12% market share in the US. Longer term, that share could be a lot larger, and this is only in the radiology space. They've just gone into cardiology, and they've won their first contract in cardiology, and that's another large total addressable market, and they've just started to go into pathology as well. So there's a lot of other ology opportunities, which is based on one platform. Many of their peers or the larger peers, they have multiple products based off multiple platforms, and hence it's not as clean or as efficient as the way they've done it. And over time, we just think they will continue to win share. They haven't lost a customer in 20 years or client in 20 years. So it's an amazing business. And so, yeah, it's a buy for us. You know, we think, you know, the catalyst is further contract awards.
Great. Next one is Jumbo Interactive.
I'd say Jumbo's probably a hold. The challenge there is sort of identifying a catalyst to re-rate the stock outside of, you know, the jackpot cycle, I suppose. They did recently sign, you know, a SaaS agreement with Queensland RSL, which is the key growth opportunity for the business, is growing the SaaS arm. Yeah, they've sort of struggled to find an acquisition that you know, makes sense there. The balance sheet's obviously in great shape, so you know, they've got I guess optionality to deploy it into a buyback or M&A. But yeah, for us, it's sort of just trying to find a larger catalyst outside of just trading the jackpot cycles. So for that reason, it's probably a hold.
Great, thanks so much. This one's from Georgina. How are you playing the AI investment trend in the small cap space?
Yeah, I mean, like it's a point I touched on before. Like in terms of getting direct exposure to the AI thematic, it's the ASX is quite frankly pretty limited. But you know, we think the highest quality play is Megaport. The CEO Michael Reeds came in there a couple of years ago, and honestly has done what we think is an amazing job in terms of, you know, really completely restructuring the organisation, refocusing the go-to-market, you know, created a real drive around new products and essentially, you know, broadening their share of customer wallet. And you're only, you know, starting to see that now, you know, come through in terms of, you know, the operating metrics. So, yeah, they've decided, you know, the best course of action is to double down and obviously drive the product development and go-to-market side harder and really try and capitalize on this AI trend, you know, which will suppress the earnings, like the operating leverage in the short term. But what we think it does is sees revenue growth actually accelerate, you know, particularly into FY2027, you know, well above where consensus is estimating. So, and then it'll be at that point, you know, they can demonstrate and show that the operating leverage can come through. So, yeah, we really like Megaport. It's one of our, you know, larger positions, and yeah, we think that's the best way to play it here domestically.
Great, thanks so much. Jeremy has asked, have you ever considered cash converters?
Yeah, I have looked at cash converters. I met them recently. It does look interesting, definitely. Yeah, I think, you know, the franchisee roll-up strategy that they're undertaking, like it's, you know, it's a proven model in terms of, you know, being able to arbitrage the model and, you know, internalize and create, you know, value by bringing them back into company hands. The exit of payday lending, you know, looks, you know, very smart to me. And from an equity market point of view, you know, people don't, you know, necessarily like the payday lending side of things. So yeah, I think it does have a good run rate in terms of, you know, the roll-up strategy, and then, you know, obviously expansion, you know, overseas into the UK. So yeah, it's actually one that I do think looks quite interesting. I'm doing work on it at the moment.
Great, thanks so much. You touched on this earlier. However, Linda has asked for your view on Superloop, please.
Yep. Yeah, Superloop we have in the fund, in the WAM Microcap fund. The management's done a good job executing on the organic growth profile and also entering into partnerships with the likes of Origin, et cetera, to grow their subscriber base. The opportunity longer term is obviously some of these younger, newer challengers taking share of the large three incumbents. And I think Sean touched on this earlier. There's a potential large churn event that's coming up over the next few months. So if they can execute on winning a larger part of that, the churn, definitely looks very attractive.
Great, thanks so much. Ian has asked what your thoughts are on EDU holdings.
Which one?
EDU.
EDU. Yeah, sorry. I got nothing I can add there.
That's all good. Bill has asked, is Australian clinical labs a likely takeover target?
Perhaps, but you would have seen ACL went, this would have been maybe 12 months ago, had looked to effectively acquire Helios. We think there's a lot of strategic rationale with the merger of those two businesses, and effectively that's perhaps a potential scenario, just if they revisited that story at some point in the future. But yeah, I mean, healthcare assets, there's always interest. We've had quite a few years ago get acquired, SDA Health, which we had 10% shareholding in, National Vets, and there was a few others. So the healthcare asset space is always pretty attractive to private equity.
The most talked about merger is ACL and Helios. We're just not 100% convinced on the ACCC clearance.
Yes.
Thanks so much. Joseph asks, do you own lifestyle communities?
We don't own lifestyle communities, but we really do like the land lease space. We, we're one of the larger participants in the recent Gem Life IPO, where we rate, founder-led business, management incredibly strong across the detail, beat their prospectus forecast by 8%, and we think they're well placed to upgrade earnings in the future. We also own Aspen, APZ in that space, remain positive on that one, and we own Ingenia too. So we like the thematic. The reasons we haven't owned LIC for a while are obviously the DMF fee and the question marks that that has, and then just the Victorian property market, generally, post the tax changes sort of 18 months ago has been very, very challenging. And obviously there's been management changeover and whatnot. So we really like the space, like the thematic. Interestingly, I'd say the conversations we're having with management teams on Victoria, it has bottomed. There are green shoots. So yeah, it probably is the time to start, revisiting LIC.
Great. Christopher has asked for your thoughts on IVE Group.
Yep. IVE will probably be a hold for us. We haven't done a lot of work recently on it. I think the share price has done well, and they've continued to, when we did the work last time, had very good management running the business. So again, it's probably one of the companies we'll put it onto our, it's currently I think around $300-400 million market cap. So we fit well in the WAM Microcap strategy, and it'll be one that we'll be looking at.
Great. The next question is from Roger, and he asked for your view on Symal.
Yeah, so Symal, we like management, and so I think one of the challenges with a lot of the services companies is there's quite a few around, and so the Symal management we've met in the past, they've done a very good job growing their business, and so so we obviously like the story backing management there, but in terms of more near term, some of the larger mining services companies, I think with more near term catalysts are the ones we've effectively gravitated towards.
Now, both of you, what do you think of Alfabs, and would you hold it at some stage?
Again, I think that's a contractor services business. Probably no real short-term views right now, but again, we have quite a few of the contractors in the fund already, and I think the key for many of them is just how do they take the next leg up into a market cap where it can get index inclusion, and as an example, as a catalyst to attract more capital into the business.
Great, thanks so much. Ashok asks, is Lovisa a buy, hold, or a sell?
Yeah, Lovisa's held in WAM Capital. We still think it's a buy. Obviously, there was a lot of concern around, Victor, the previous CEO, sort of exiting the business and what that would mean going forward. But if we take a step back, we think they've got probably the best management team in the country in retail. Mark McGuinness has been brought in as a chairman, and I can tell you he's not getting paid $1 million as a chairman to sit on his hands and do nothing. We really rate Mark from his, in previous endeavours at Premier. And then obviously they've brought John Chesson in as well, who was previous CEO of Smiggle. We think they're really high calibre retail executives. You can see through the second half that the store rollout is re-accelerating. And then, really pleasing to see the like-for-like momentum improve to, I think it was 5.8, sort of 6% through that July-August period. So, we think the business looks like it's got really strong momentum. There's still a high level of short interest in it that's not easy to cover in the screen. So, we think this one can keep going.
Thanks so much. This question is from Lloyd. Thoughts on Fleetwood Limited?
Fleetwood, not one I've sort of looked at more recently. Again, it probably goes to the point that we already hold a lot of, I suppose, similar investments within this space. So not one we sort of own at the moment, but have in the past. And clearly the guys, they've done a good job in terms of restructuring the business and sort of refocusing it. But probably not one we're in at the moment.
Great, thanks so much. This question is from Stephen. Is a 10 cents per share dividend unfranked identical to a 7 cents per share dividend fully franked?
I think that depends on you as a shareholder, the specific financial situation. If I understood the question correctly, and the value of franking credits to you. So if a shareholder values income more versus the value of the franking, a higher unfranked dividend will be more beneficial and vice versa. So I think it really comes down to the financial and tax situation for the shareholder.
Great, thanks so much. Ian asks, what is your opinion on Mineral Resources?
Yeah, it's clearly been a very topical stock over the past 12 months. I think ultimately, if you think iron ore's, going to iron ore prices again is sort of hanging around here, and they can bring their production online without any hiccups, which does seem as though, they're on track for at this point. Then it probably is good buying here, I think. And then clearly, I'm not going to call the bottom in the lithium market just yet. I think it's sort of bouncing along the bottom. But if we continue to see more supply cuts and you start to see lithium prices, lifting from here, then you get a free option on lithium too. So I think it's a buy here.
Great. Peter asks for your thoughts on Premium.
Premium. So we have Hub and Net Wealth in our funds. Premium is a little bit smaller. I think for that one, we're still waiting to see real operating leverage. Because of the smaller scale, they can't use the scale advantage as some of the larger the challenges, such as Net Wealth and Hub they've invested a lot into the tech stack and into the sales network and into products. So Premium, I think the result was actually a decent result, but I think we were looking for more sort of traction on the operating cadence to really look at it.
And we've got an investment in Hub as well.
Yeah.
So we're probably just playing that thematic sort of through Hub. I mean, that's a proven operator with incredible scale and still a very strong pipeline for flows.
Great, thanks so much. Joseph asks, what is your view on Cedarwood's properties?
Yeah, Cedar Woods is a buy for us. We own that one within WAM Microcap. Yeah, clearly management, have executed, strongly throughout this period. You're seeing broad-based price growth in each of their markets. WA has obviously been strong, Queensland as well, and Adelaide too. We think, much like FY2025, the initial guidance they've set for FY2026, 10 to 15% NPAT growth from memory is conservative. And, we think there's definitely prospects of earnings upgrades there. I'd say in terms of other catalysts, this one's pretty close, if not, for ASX 300 inclusion in March. And it's a fairly liquid stock, so that will be a good tailwind for the share price. And then I'd say more medium term, we like their capital light partner strategy where they're bringing in, some other partners to fund the development, which ultimately increases, the ROE. So, yeah, we like Cedar Woods. It looks well placed.
And what is your view on Accent Group?
AX1 is a sell for me. I think the brands are struggling for relevance. Just the, I guess the ongoing disintermediation and brands looking to go more and more direct to consumer, I think makes it, more and more challenging. We saw through the recent, I guess reporting period that, pretty much every retailer reported buoyant current trading in July and August. And I think Accent's comps were flat or sort of very low single digits. So, yeah, our question mark, is probably more around the potential structural headwinds the business is facing at this stage. So we just think there's better players elsewhere.
Great, thanks so much. Marcel has asked if you have any thoughts on Singular Health Group. Is Vulcan Energy Resources a stock that you would consider?
I can't say I can give you much insight on either, to be honest, sorry. But I'm very happy to have a look at. I've never even looked at SHG, so that's on this afternoon's list.
Thanks, John. Ashok has asked if you hold Digger Data in the portfolio.
Unfortunately, we were keen to participate in the sell down, but that didn't sort of eventuate for us. Yeah, I mean, Dicker Data, I think it's a buy. You've got obviously the tailwinds for, small, medium businesses with, improving economy, falling rate environment. And then they should be a beneficiary of, the AI replacement cycle in, laptops and things like that. So, yeah, I think it's still going up, that one.
Great, thanks so much both. So those are the questions we have received. If we didn't get to any during the webinar, we will get back in touch with you. Before I hand over to you, Tobias, for your closing remarks, I just wanted to touch on how we will be travelling to Newcastle, Toowoomba, Gold Coast and Noosa in October for our shareholder presentations. You will be able to meet the investment team and grab a coffee with them during this presentations. If you are interested, please do register using the QR code displayed on the screen. But I will pass over to Tobias for some closing remarks.
Well, look, thank you everyone for sending through the questions and to Sean and Emiko for joining us today. The recording of the call will be available on our website shortly. As always, these are your companies. Please get in touch with us via phone or email at any time, and really appreciate your support. Thank you and have a great afternoon.
Thanks so much.